Okay, so we had begun the sequence stage decisions. We solved one question. I think I give you an assignment. Okay. Then in that case, today we look at another question. Yes.
The decision was supposed to be so you just take any of the two.
Yeah, you take any of the two. You take any of the two. So let us go to May 2016, question 3A. May 2016, question 3A. May 2016, question 3A. And the question reads that Sawasawa Limited is a fitness center serving traders within the Central Business District. Currently, the center has 4,000 members, with each member paying a subscription fee of that 5,000 per annum. The center comprises of a gym, a swimming pool, and a small exercise area. A competitor plans to open a new fitness center within the same locality. This is expected to cause a decrease in membership numbers for Sawasawa Limited unless its facilities are upgraded. Consequently, Sawasawa Limited is considering the following options in a bid to improve its membership numbers. Option 1, no upgrade, and in this case, membership numbers would be expected to fall to that 250 per annum for the next 4 years. Operational costs would remain unchanged at the current level of shillings 4,500 per member per annum. Option 2, upgrade the exercise areas. The capital cost of this upgrade would be shillings 18 million. The expected effect on membership numbers for the next 4 years is as follows. So we have probability and the effect on membership numbers. The effect on operational costs for the next 4 years is expected to be, we have the probability there and the effect on operational costs. Any improvements are expected to last for 4 years. Now, using the expected monetary value criterion, recommend the decision that Sawasawa Limited should make. Now, in dealing with this question, the first thing we say is to know the objective. And as you can see, the objective here is to maximize profits. If you are the owner of this center, you will be seeking to maximize profits. Number 2 is to know what are the options, and we say the options is what is within control. So these guys, they are able to decide whether they will upgrade or they will not upgrade. And then number 3 is to know the outcomes. Outcomes are beyond control, and outcomes are expressed or they contain probabilities. So you can also look at how many sets of probabilities we have. And you can see there are 2 groups of probabilities. There is the one on membership and the other one on operational costs. So that tells you we have more than one. And if we have more than one, that is a multi-stage decision. Then from there, we now seek to know how to to come up with a sketch. We come up with a sketch of the tree. So the sketch will be like this. We are talking of either upgrading or not upgrading. Then when you don't upgrade, things remain as they are. If we start by upgrading, when you upgrade, there are two things. There is the membership, and then costs are also two of them. Costs are also two of them. But when you don't upgrade, things remain as they are. So this tells you you are going to have a tree that has 1, 2, 3, 4, 5. You are going to have a tree that has 5 tails. You're going to have a tree that has 5 tails. So with that now, we can proceed and come up with the formula of the profit. How are we going to get the profit? For us to get the profit, we will need to get the revenue. Obviously, we minus the cost, and that will give us the profit or the payoff. So having said that, we can now embark on implementing that. We can embark on implementing that. Whereby we can have total contribution. Total contribution being equal to time in years multiplied by annual members. Annual members. Multiplied by cost per member. Cost per member. We minus fee per member. So that is how we are going to arrive at the profits. That is how we are going to arrive at the profits. So as I've been telling you, anytime we are drawing the trees, you start from the reverse. From the end of your page, unaanza kuspanga hivi vizuri so that you don't squeeze. Then from there now, So that is the decision tree. Those who are online, once you finish drawing, you write finished. Yeah, yes, Boro and Rihanna finish. Okay. So we can start recording. So here we have upgrades. We can upgrade, and the upgrade we are told it will cost 18 million. It will cost 18 million. So write 18 million here. And it is in brackets. 18 million is in brackets. Then for the memberships, we have members here, 4,000 members with a probability of 0.3, and then we have 4,800 members. 800 members with a probability of 0.7. With a probability of 0.7. And then costs, we are told it will be shillings 6,000 with a probability of 0.4. All cost per member will be shillings 8,000 with a probability of 0.6. And the same case here, 6,000, and here shillings 8,000 with a probability of 0.4 and 0.6. And then if you don't upgrade, you will have that 250 members. That's 250 members at a cost of shillings 4,500 per member. 4,500 per member. I think we are okay at that point. And if we are okay, we start recording these values here. The fee every member is paying 35,000. Every member is that 5,000. That 5,000. The cost per member, this is 6,000. This is 8,000. 6,000. 8,000. 4,500. Annual members, this is 4,000. 4,000. Then we have 4,800. 4,800. And that's 250. And the time in years is 4. The time in years is 4. So from there now, I told you as long as you write these figures directly below the word up there, you don't have to keep on repeating these sides and brackets and whatever. Anyone looking at that now can clearly see that, like the way you are seeing them. They are very well understandable. So 35,000 minus 6,000 equals times 4,000 times 4 is 464 million. 464 million. 35,000 minus 8,000 multiplied by 4,000 times 4 is 432 million. 432 million. 35,000 minus 6,000 equals times 4,800 times 4 is 556,800. 35,000 minus 8,000 times 4,800 times 4. I'm getting 518, 400, 400. 35,000 minus 4,500 times that 4 times 4 is 396. 500,000. 396, 500. All the figures confirmed, eh? Okay. If all the figures are confirmed, then we proceed. Okay. So proceeding down there, we prepare a table where we will have a node here. Then expected monetary value in millions. Expected monetary value in millions. Expected monetary value in millions. So we start with node number 1. Told you what to do. You come here where there is this node 1 and look at what kind of lines are going out. If the lines are complete, these ones are called complete lines. These ones are called incomplete. So if the lines are complete, you multiply the probabilities with the payoffs at the end as you add. So this then will be 0.4 multiplied by 464 million plus 0.6 multiplied by 432. So do that and give me the answer. What do you have? 444.8. 444.8. We go to number 2. Number 2 is you do the same thing. It will be 0.4 times 556.8 plus 0.6 times 518.4. Those who are online, also send your figures. Send your figures. Mm-hmm. 533.76. 533.76. Okay, we go to number 3. Now going to number 3, again you can see the lines going out are complete, so we have to multiply. And this one has something additional. You see the line coming in. The line coming in is incomplete and it has a cost, so you will subtract this one. Now for these ones, we are not subtracting because if the line coming in is complete, there is nothing to subtract. Or in simple terms, if the line coming in does not have a cost, there is nothing to subtract. So following number 3, it takes us to number 1. So we will have 0.3 times what we got in number 1, 444.8 plus 0.7 multiplied by 533.76. Then you minus 18 million. You minus 18 million. So you say 0.3 of 444.8 plus 0.7 times 533.76. Check whether you get 489.072. That's all? Okay. Then we go to number 4. We go to number 4 and do the same. Now here, the probability is just 1. The probability is just 1. So it is a case of saying 1 times 396.5. So the answer is 396.5. 396.5. Then number 5, when you get to number 5, you realize that the lines that are getting out of 5, they are incomplete. So if the lines getting out are incomplete, you select the values where they are going. So it's going to number 3 and number 4. So we take the higher. So it is the higher EMV at nodes 3 and 4. So the higher one is 489.072. The higher one is 489.072. And where you have selected that one from, you need to show us that 489 has been picked from number 3. So you come here and mark something like this. You mark it that way. That means we have selected to upgrade. And that should be communicated to the client in form of the advice. The advice is upgrade. We should upgrade the center, upgrade the facilities. You need to upgrade the facility. You need to upgrade the facility. The next thing, although it is not required in this question, is called value of information. Value of information. Value of information. So in the value of information, last time I taught you how to use the two formulas to get the value of information. But when you are dealing with the trees, you come here at the last point here and identify the highest EMV or the higher EMV, depending on how many they have. So when we are here, there are two. So the higher is this one, 489. 489.072. Then we subtract the second higher or the second highest. So this one, and the second highest now is what we have here in number 4, because we are comparing the values that are coming from here. So not any other value. It is the values coming from here. Otherwise, if you look for the other values, even this one is not the highest. So at number 4, it is 396.5. 396.5. So minus 396.5, that is 92.572. 92.572. So that is all that we can say about that question. And nonetheless, you have a concern, I wish to proceed. Let us now go to May 2017. May 2017, question 1A. May 2017, question 1A. Yes, you deal with these ones only, the ones at the end, and not for the voice. This is not voice, it is value of information. Guru, I hope you have gotten that. It's not voice, it is value of information. Have you gotten that? Good. So read that question on your own. May 2017, question 1A, as I clean my whiteboard. So you are finished reading, eh? Now that question is about a concert, and they want to decide on two things. Do you advertise or not advertise? That is the option. Then we have two types of outcomes, weather and demand. So which one do you think should come first? Is it weather or demand? Huh? Which one goes before the other? Huh? Even yourself, when you go to a hotel, do you first of all decide whether you take a hot drink and then the weather becomes hot or cold? Or you first of all observe the weather, then you decide whether you take a hot or a cold drink? Yeah, so the weather comes first. So if the weather comes first, it is either good or poor. It is either good or poor. Then we are told when you advertise, there is a possibility of stimulating the demand or not stimulating the demand. You stimulate the demand or you are not able to stimulate the demand. So that means we have 1, 2, 3, 4, 5, 6. So we are going to come up with a tree that has 6 tails. We are going to come up with a tree that has 6 tails. Now for the issues of profit, it is already given. The payoffs are already given there, so we don't need to design a formula for computing. So we again try to design that. We try to design. I told you you should go to the end of your page. Maybe we can have the profits. Profits, shillings in millions, shillings in millions, shillings in millions, shillings in millions. So the tree, tumesema we are going to have 6 tails. We will have 6 tails. So 1, 2, 3, 4, 5. And we will start. Let's see where that's going to share. So I go to 40, go to 55. 70. So this is 1, 2, 3, 4, 5, 6. So this is our decision tree. Decision tree. We are saying you can have the advert, and the advert goes for 15 million, so 15 here, or you can choose no advert, and the weather will either be good or poor. The weather will either be good or poor. And the probability that the weather is good is 0.3, poor 0.7. 0.3, 0.7. And if the weather is poor, you sell 5,000 tickets. The weather is poor, 5,000 tickets. But if it is good, you sell 10,000 tickets. But we are told if you advertise, there is a 60% chance that you sell 7,000 if the weather is poor. So this is 7,000 tickets. And the probability is 0.6. So just a minute here. You see, when they tell us you stimulate to 7,000, it means there is a possibility, or it means you are coming from the 5,000, which you are able to sell when you have no advert. You have no advert when the weather is poor. But and when you do the advert and the weather is poor, you stimulate 7,000, or the advert has no effect. So if the advert has no effect, then you just sell like what you have sold if you did not do the advert. So therefore, this will still be what? 5,000 tickets. 5,000 tickets. And the probability is therefore 0.4. And going by the same argument, this becomes 13,000 tickets with a probability of 0.25. And then when you don't have the advert, it is 10,000 tickets with a probability of 0.75. And when you sell 13, the payoff is 150, 90, 35, minus 20, 90, and minus 20. So finish up. Okay. So we are finished. So if you are finished, then we have a normal working down there. Working. Where we have the node and then expected monetary value. Expected monetary value. So number one, it will be 0.25 times 150 plus 0.75 times 90. So get your calc and tell me what that figure is. 0.25 times 150 plus 0.75 times 90. Mm-hmm. 105. Yes. 105. Then when we go to number 2, it is 0.6 times 35 plus 0.4 times minus 20. So 0.6 times 35 plus 0.4 times minus 20, it is 13. Then when you go to number 3, it will be 0.3 times what you have in number 1, which is 105, plus 0.7 times what you have in number 2, which is 13. Then you minus this one, because there is a cost getting in. So times 0.7 minus 15 plus 0.3 times 105. 25.6, that's all. Okay. Then we go to number 4. Number 4, it will be 0.3 times 90 plus 0.7 times minus 20. So 0.3 times 9 minus 0.7 times 20. 13 again. Then number 5, you select. It is the higher at 3 and 4. 3 and 4, so the higher is 25.6. So if it's 25.6, that has been selected from number 3. That way, So from there, we give the advice. The advice is we should advertise them. Advertise the concert. And then, as we said, you compute the value of information. The value of information. So the value of information, VOI, it will be 25.6 minus 13, which is 12.6. Which is 12.6. That's okay now, eh? Okay. So on your own, I propose that you attempt the following two questions. November 2016, question 3. No. Yeah. Give you something very easy. November 2017. November 2017, question 4A. November 2017, question 4A. And May 2018, question 1. And May 2018, question number 1. Number 1. So do those assignments and submit them for marking. You submit them for marking. So we are through with that first topic. We are through with the first topic. And it's a very, very important topic as far as the examiner is concerned. You'll be noticing almost every exam has a question, either single stage or multi-stage. Because of two reasons. One, decision making is very important, even in general life. Every day you are making decisions. And number two, the examiner knows that there's a topic we teach when very many people have not yet come back to school. So during the exam, very few will have an idea. So you can see now, I think the only person here who has gone fully through the class is Bernard and Oro. So out of the many students you have by the end of the semester, only 2 will have gone free through that topic. So examiner akiweka kaswali hapo, then many people will see stars. But at least for you, you have the idea, or you have the advantage of coming early. So let's proceed to the next agenda. The second topic, which is also very familiar to you, costs forecasting. That is the topic, cost forecasting. Cost forecasting. And you write the following notes. Costs refers to the monetary value. Refers to the monetary value of all the economic resources. The monetary value of all the economic resources which are used. All the economic resources which are used in the production of a product, in the production of a product, or provision of a service, or provision of a service. Provision of a service. Yeah, that's the meaning of the cost. There are many definitions, but for us, I just want us to confine ourselves to that. It is the monetary value of the resources. Now, like for what I'm doing, I'm providing a service. For me to provide this service, I require resources. One of them is the space. We require this building. So this space has the monetary value. The landlord has told us, if you're using my space, this is the much you should pay me. I require this electricity. KPLC has given us the monetary value of this. I require human resource. For me to teach here, I've told the school how much they should pay me, and many other resources that are used. So when you combine the money value of those resources, that is what we call the costs. Point number 2, the next point is there are various ways. There are various ways of classifying costs, but the most important costs, in forecasting are the most important costs in forecasting are: number 1, fixed costs. Fixed costs. And write that this is a cost. This is a cost whose total amount does not change. This is a cost whose total amount does not change as the activity level changes. As the activity level changes. First, it is usually expressed. It is usually expressed as a single total figure is a single total figure. The second type inaitwa variable costs. Variable costs. Variable costs. Right, that this is a cost. This is a cost whose total amount changes in a direct proportion. Changes in a direct proportion as the activity level changes. As the activity level changes. It is usually expressed on a per unit basis. Per unit basis. It's usually expressed on a per unit basis. Per unit basis. Number 3, mixed costs. Mixed, or some people call it semi-variable costs. Mixed costs or semi-variable costs. Right, that this is a cost. This is a cost that contains both fixed and variable components. Fixed and variable components. The components are separated. The components are separated using high-row method. The components are separated using high-row method unless otherwise stated. Unless otherwise stated. Direct costs. Direct costs. Right. These are costs. These are costs which can be clearly identified. Which can be clearly identified with the product. Clearly identified with the product. First, the sum of direct costs is called prime costs. The sum of direct costs is called prime costs. First, for purposes of forecasting, direct costs are treated as variable costs. Direct costs are treated as variable costs. Indirect costs. indirect costs. These are costs which cannot be. These are costs which cannot be clearly identified. Which cannot be clearly identified with the product. Clearly identified with the product. The sum of indirect costs is called overhead costs. The sum of indirect cost is called overhead costs. Indirect costs are treated as fixed costs. Indirect costs are treated as fixed costs for forecasting purposes. For forecasting purposes. And elsewhere, unless otherwise stated, and elsewhere, unless otherwise stated. Okay, so I think those things are clear. There is nothing that I need to explain. As I've said, there are many ways of classifying costs. Remember in your section 2, or when you came across cost accounting, you were taught very many types of costs. But for our case here, those are the ones that we need to do forecasting. Okay, then down there now, right, that forecasting refers to the process of determining in advance. The process of determining in advance. It is beneficial in such ways as I want you to allow a space of not more than 6 lines. Some 6 lines. So that is an assignment. On your own, you look at what are the advantages of forecasting. When you forecast something, when you predict, what are the advantages? So you write the statosha. Yeah. Then after you have estimated the 6 lines, so I've said forecasting is the process of determining in advance. Forecasting is the process of determining in advance. Have you gotten it, Boro? Good. And I've already said you allow space of 6 lines where you shall write the advantages of forecasting or the benefits. So having allowed that space, down there you write the following: that cost forecasting is based on the assumption. That total costs can accurately can accurately and objectively be separated into fixed and variable components. Fixed and variable components. That is, total cost is equals to fixed costs plus variable costs. Total cost is equals to fixed costs plus variable costs. Now, this is a very, very important statement, and you keep on seeing it even in other topics. When we say that we can separate total into these two, we expect that everyone will be accurate. All of us, if we are auditing or we are analyzing a company and we are given the various costs, like what I can say, kuna stima, kuna rent, kuna mishahara, kuna all those types of costs, that all of us will be able to accurately classify them as fixed and variable. And then we'll also be objective. By objectivity, it means what I will call fixed is also what you will call fixed. You know, what I may call fixed is not necessarily what you call fixed. Or what I will call small is not what you will call small. Maybe to me, 50 shillings is a small amount of money. To you, 50 shillings is a lot of money, or vice versa. So the question is 50 shillings small or a lot of money? So that is addressed by objectivity. Then down there, we write that this is then expressed as a linear function. This is then expressed as a linear function of the form y is equals to a plus bx. Is a linear function of the form y is equals to a plus bx, where y is equal to total costs, a is fixed costs, b variable costs per unit of activity level, and X is activity level. And MB common measures of activity level. Common measures of activity levels include output units, hours, guests, kilometers, etc. Common measures of activity include output units, hours, guests, kilometers, etc. Two things that you need to note is that this equation is very, very important as far as this subject is concerned. You get to understand this, you have understood more than 20% of the marks of this. Because you'll keep on using this equation in various topics. You keep on using it. So you must be able to understand it. You must be able, and you'll be seeing that as we go by and by. The other thing is that you can see this one at lower levels in section 2 or section 4, you are told this is the variable cost per unit. And you are told X is the number of units. But at this level now, which is advanced, we expect you to know that activity level is not only measured in terms of units. There are other measures depending on the company that you're dealing with. Like if you come to a company like us, our measure of activity level is the number of students. If you go to analyze KNH, the measure of activity level is the number of patients. If you are an accountant of City Hopper, their measure of activity level is the kilometers or even passengers. So this one is open. That's why I've left it open instead of saying number of units, because it's not all the times you get it as number of units. Good. Then down there we write that the following steps are taken. The following steps are taken when developing a cost forecasting function. A cost forecasting function. A cost forecasting function. Number one, identify the dependent variable. The dependent variable y. The dependent variable y. Full stop. I'm still page dog. This is the variable whose values are being predicted. This is the variable whose values are being predicted. Step number 2. Identify the independent variable X. Independent variable X. And we explained logo. This is the variable. This is the variable that makes the values of y to change. It's the variable that makes the values of y to change. Number 3, gather data. Gather data relating to X and Y. Relating to X and Y. Step number 4, analyze and plot the data on a graph. Analyze and plot the data on a graph. Number 5, observe the pattern portrayed on the graph. Observe the pattern portrayed on the graph. and develop an appropriate function. And develop an appropriate function. And the last step is test the reliability of the function developed or the function obtained. Test the reliability of the function developed. So I think even with that, we don't have much to discuss. Then down the write that. The following methods are commonly used in forecasting. The following methods are commonly used in forecasting. Kwanza anaitwa scatter stroke visual fit diagram. Scatter stroke visual fit diagram. Number 2 is called industrial engineering method. Industrial engineering method. Number 3 is called accounts analysis method. Accounts analysis method. Number 4 is called high-rule method. High-rule method. Number 5 is called regression analysis method. Regression analysis method. Number 6 is called learning curves. Learning curves method. Number 7 is called time series. Number 8 is called Markov analysis. Markov analysis. And number 9 is called input output analysis. Input output analysis. For your AMA syllabus, these 3 are not included. So we will not go back those ones. They were well covered in section 4, and they are not even examinable here. So I've just mentioned that you take note, they are also forecasting methods. So we just focus on the others. So let's start with the first one, scatter. Scatter or visual fit method. And write that this is where the values of X and Y are plotted on a graph. The values of X and Y are plotted on a graph. First of all, it is called scatter diagram. It is called scatter diagram since the points are scattered all over the brain. Since the points are scattered all over the brain. It is called visual fate method. It is called visual fate method because a line of best fit, is visually drawn to enhance visibility of the pattern. Visually drawn to enhance visibility of the pattern. The pattern gives an idea. Of how the future costs will appear. So this is what you're saying. We will not draw this. It's even very difficult. They will examine this. You just gather data as you have said in one of the steps. You have the values of Y here and the values of X. Then you plot the graph. When you plot the graph, those points may be scattered all over. That's why it's called a scatter diagram. And we expect you to observe the pattern. When you just have the dots here, the pattern may not be very visible. But you may want to draw a line, maybe a line like this one, the line of best fit. Now this one, it is more visible now compared with the points. That's why it's also called visual fit. So assume that your cost had come to 100 here, and these were 5 units. Then this pattern tells you that as the units increase, the cost will also increase. So in case you are intending to produce some units less than 5, then you should be able to spend something less than what? 100. It gives you an idea. If you intend to produce anything above 500, 5 units, then you have an idea that requires something slightly above what? 100. So this one is just giving you an idea, just giving you a suggestion. I have just 1 minute, so I don't want to extend. So you will stop at that point, then we pick up from there in the next lesson. That should be on Friday. Because of the constraint of time, we will be having some Sunday classes once in a while. The first one is coming this Sunday. From 6:30 to 10. So you budget for that, so that we are able to complete the syllabus visually without much hurry, and we avoid the last minute rushes. Yeah, the earlier you do it, the better. So this coming Sunday, we budget. We meet from 6:30 to 10. Thank you so much. Have a nice day and continue telling your friends that you have begun. They need to come.